Welcome to the program. My name is Marty Schenkman. I'm joined by a friend and colleague, Jonathan Blotmacher, and we're going to talk about year-end, primarily estate, but maybe a little tax planning for 2022. And it's different, so stay tuned. And even if you've heard other year-end tax planning programs, I think we have some interesting things to say that will hopefully intrigue you and at minimum give you food for thought. And Jonathan, I think the best thing about our food for thought is it's low calorie. Disclaimers, a couple of webinar pointers. The handout is available on the console. You can download it by clicking on the handout tab. If you miss getting this, a recording of the program and the PowerPoint will be on the Schenkman Law website. It'll be on the Peak Trust website. It'll be on the ILS website. So there'll be lots of easy ways to get it. There's a growing library of more than 150 video planning clips on laweasy.com, and it's actually not 50, 150 webinar recordings on Schenkman Law. Jonathan has been a co-conspirator on many of those. We don't officially give CLE or CPE, but you will be sent a certificate of attendance from the system after the program. We cannot manually override or change those. And finally, if you have questions, best to email Jonathan or I or both directly, not to put them in the Q&A box. So if you can all do that, that would be great. And we have two sponsors. And first, our word from Vanessa Kanega.
Thank you, Marty. And just one comment. We all know that anything you eat during the holidays, it has no calories in it. So this is really,
especially with chocolate,
no different.
No calories.
That's right. That's right. It's actually burns. So
Vanessa, I'm going to be very rude and interrupt you. What is the best holiday present? The best holiday present you can think of to get anybody? A subscription to
Interactive Legal.
Yeah.
We actually just did a campaign along those lines. Thank you, Marty. I promise we don't pay Marty to say these things. But thank you, Marty. Thank you for presenting this webinar. If anybody is like me, you can't believe it's already the end of the year, but we always have to consider what planning we're doing and what we're wrapping up at the end of the year and look forward to the new year. So glad that Marty and Jonathan are speaking on this topic, and Interactive Legal, as always, is glad to sponsor. I'm Vanessa Kanega. I'm the CEO. For anybody who's not aware, Interactive Legal provides automated document drafting software and solutions for estate planning and elder law attorneys. You can find more information at our website at interactivelegal.com, or please don't hesitate to email sales@interactivelegal.com that you see on your screen. And thanks so much.
Thank you, Vanessa. And remember, everybody, it's an awesome holiday gift. Andre, from our favorite trust company, actually now in Alaska, Nevada, and Delaware. You guys are like growing like tribbles. If you don't know what tribbles are, folks, you got to go watch all the old episodes of Star Trek till you find out. Andre?
Welcome, everyone, and thank you for attending today's webinar. My name is Andre Sears. I'm the Business Development Officer for Peak Trust Company. We're pleased and honored to be able to sponsor today's presentation. Peak Trust Company offers a full spectrum of trustee services servicing individuals, families, and their trusted advisors. We offer flexible and customized administrative services for all types of trusts. We currently offer services in 3 of the top tier trust jurisdictions, and that would be Alaska, Nevada, and Delaware. So I invite you to visit our newly updated website at www.peaktrust.com. And if you have any questions, feel free to reach out to me directly or to any of the other members of the Peak Trust team. Enjoy the webinar. Back to you, Marty.
Andre, thank you. And is it true that if I open a trust account, I get a salmon?
Either salmon or a reindeer hot dog.
Oh, wow, I didn't even know those existed.
Oh yeah, and they're good.
Well, on that note, we're going to jump into the technical aspects of the program. Let me give you just a quick overview, and we're going to push through some of the parts because I really want to get to the stuff at number 9 in particular, and number 7 about planning for 2026 and why you want to do it now, and sort of rethinking exemption and annual gift exclusion, gifts and transfers, and so on. Keep in mind that even if you're not using these ideas before year end, and some of them I think have some real interesting implications before year end, these will be helpful, I think, as you plan in the coming years. We're going to talk about Smaldino and Levine, but we're not going to talk about them in any great depth. We've done separate webinars on both of those, Jonathan and I with some other colleagues. We're not going to mention really split dollar. We're not going to talk about that at all. What we want to do is give you some thoughts and comments on the Smaldino and Levine cases as how they affect planning generally and year-end planning as well. There's some great general lessons that go beyond the fact patterns of those cases. And I'm going to push Jonathan to get through that quickly because there's so much more to come. Monitoring trust income is something you need to do at year-end, 65-day rule. I'm going to let Jonathan wax eloquent on that. Valuation adjustment clauses, a few comments and some comments on some recent valuation developments. The GRAD CCA we've talked about in prior webinars, but we'll cover it quickly. And the Batty case is relatively new. And I put this in here because when you're rushing to get stuff done by year end, there's always valuation issues. And some of the same issues that came up in the CCA and case, I've seen in practice just recently. So it's not just theoretical and it's not old. Rescission is something that I've never had in a year-end tax talk until this program. And I included it because Jonathan and I lectured about it extensively when we thought in 2020 and 2021 the rules could change at any minute. But you know, it's just something good to keep in your little toolkit as you approach year end. The Welland malpractice case, we're just going to give it a minute or two because it's just some of the thoughts you want to keep in mind doing planning. We're going to talk about why, and this is really important for year-end planning. If you can get clients to take some steps now, in anticipation of 2026 when the exemption, as you all know, will be cut in half. And we're going to talk about what that means to year-end planning. Whether you use these ideas before this year end or just apply them in general in planning before 2026, I think they'll be practical and helpful. I don't know how much time we're going to have on the anti-clawback regs. We'll just bring it to your attention. There's been, again, other programs that Jonathan and I did with Bob Keebler just on that topic. We're going to talk hopefully for some length, and Jonathan, I want to make sure we save time for that, annual gift exclusion gifts and what they mean, what you should be doing with them. I think there's some significant differences from many of us have done in the past. We'll talk about that. Just briefly, because there's so much charitable giving at year end, I just wanted to highlight a couple of recent developments to caution people. And the last one is 30 seconds, and I can just tell it to you now. A lot of our clients and a lot of us can't qualify to deduct IRA payments, and many advisors suggest, well, if you can't deduct it, it doesn't pay to do. I don't agree because I make a non-deductible IRA payment in January of every year. Why? Because it's, to me, a great asset protection tool. It's a separate, independent little pot. I think very hard to pierce, protected, at least under my state law, something to think about. So if we don't get to topic 11, I've just covered it. So Jonathan, I want to talk with your help about Smaldino and Levine, but I don't want to talk about split dollar. I just want to talk about some of the lessons that we've learned from Smaldino and Levine that are pertinent to planning now, planning in general. And in Smaldino in particular, and we'll come to it again later, the step transaction doctrine. You want to talk a little about that? Because that's something to keep in mind as we approach year end.
Well, yes, the Smaldino case is very interesting because you had a husband who had apparently used up all of his exemptions but wanted to give more to his children. So he gave an interest in his real estate LLC or limited partnership to his wife. And the next day she turned around and gave it to a trust for his kids, not to her kids, but to his kids. And she actually testified at the trial saying she felt she had to do that. And, you know, that's a classic step transaction type transaction. But it turned out that they could not have done it wrong because not only did he give it to her and the next day she gave it to a trust for his children, she never was listed as a partner. She never got a K-1. No one was ever advised that she had it for creditors or otherwise. And it really looked like it never really happened, except she was his straw person in making an additional gift to the trust. So if you're going to have the husbands and wives make gift, you've got to do things to show that the recipient spouse really is the owner. For example, declare a distribution, have the money go to the recipient spouse and have that spouse spend it. If there are marketable securities or other things in there, change them so that there's some difference in what he gave her and what she in turn gives to the kids. Smaldino is an unfortunate case for the taxpayer. It's an unfortunate case for all of us, except it shows what you should not do, and therefore indirectly tells you what you should do.
So one of the reasons, folks, that a lot of this happens with the K1s and some of the other stuff, I still see it. Many, and I don't know if it's a lot, most, but there's certainly a reasonable number of accountants, and this is not a criticism. I practiced for many a year as an accountant. Prefer or think it's cleaner, easier, simpler to have a year-end cutoff. So what they're going to do is say, okay, make the transaction effective 12/31. No, if you have something effective 12/28 and you make an allocation of 2 over 365 or whatever the proration is for the year to the donee spouse, let's say the wife in the Smaldino context, that's a wonderful thing because you're showing and you're respecting the reality of the transaction. So this idea when you get towards year-end gift, oh, just make everything effective 12/31, then we don't have to have allocations. You want an allocation. I think it's great to show the donee had something, even if it's a couple of days of income allocation for the year, because now it's shown that that transaction took effect this year. Now, I don't know, maybe Jonathan, you have some better insight than me. I don't know if there's any law saying it's better that it happened, even if it's only for 2 days, but I can tell you my whole career, I've always felt if you can get something done in 2022, right, in the current tax year, even if it's for a small stub period, it gives more credibility to whatever transfer you do down the road because it's like in a different tax year. There's something sort of special about getting something done in different tax years. So even if you have 3 months of time between steps in a plan, if one of those steps occurred in a prior tax year, it just seems to feel better. Is there any basis for that, or is that just something most of us tend to think?
No, that's just, Marty, as you know, that's just good planning. And in fact, it would make a lot of sense if people are willing to do it. And I've done this in my family, where you give it to the spouse and you don't say to the spouse, by the way, I expect you to immediately turn around and give it to my kids or to our children or whatever. Allow the spouse to hold it and then go to the spouse and say, you know, it would be beneficial for the estate plan if you in turn would give it to the children or a trust for the children. Or maybe you even have the wife create a new trust. That would have really helped in Smaldino, I think, but she just added it to a trust her husband had created for the children. Now, that's very, very important because otherwise they're going to say she's nothing but a straw person and they're going to ignore it. And there's a lot of case law saying that, you know, if I give something to A who immediately gives it to B, it's going to be treated as though I gave it to B. And then you don't want that situation. Not only are you not going to get the tax benefits you want, but the IRS is going to be very suspicious of anything else you do. And you may face penalties, and certainly you will incur legal fees in trying to defend what you've done.
Forgive me for what I'm going to say. Wasn't Wizard of Oz the first straw man case?
You know, Marty, that may well be true.
We're going to talk more about some of this when we get to the year-end planning for 2026, but the concepts of what came out in the Smaldino case, and there's a bunch of slides here on it, and if you really want to dig into it, we have an entire program, I believe, on it that Jonathan and I did. But again, you have to observe formalities. Many practitioners dismiss Smaldino as bad fact, bad law, but it's not. It's a wonderful checklist of everything not to do. And I think the formalities that we need to adhere to, signing the operating agreement. So for example, one of the things in Smaldino, they created the operating agreement. The operating agreement required the manager or something to approve a transfer, and they didn't do that. All they would have to do is a little two-liner. I'm the manager, and under article whatever, the operating agreement, I approve the transfer to Mrs. Smaldino or from Mrs. Smaldino to the trust. They ignored their own formalities. You don't want to do that. And by the way, the Holman case, and Jonathan, just a quick comment on it, 6 days was respected, but do we want to rely on that?
I don't think so, Marty. Remember, the taxpayer gets the lesser of the form or the substance. And in Smaldino, they had very poor form. They also had very poor substance. So you're going to be losing in a case like that. I like to have a lot of time. I like to show that the recipient actually got something, control it. The best thing is, and again, if the client is willing to take the risk, give it to the other spouse, and don't tell that other spouse that you expect him or her to turn around and give it to a trust for the kids. As I said, if it's a second marriage situation, it may be that if you can convince your spouse, you create a trust for my children. And again, you have to raise questions. Why would someone do that when the other spouse has children or descendants of his or her own?
So on slide 16 is something that you got to keep in mind all the time, but it comes up a lot at year end. And it was really, the court just hammered the taxpayers in Smaldino on this. Never, ever, and if you can think of an exception, interrupt me, never, ever date a document effective at some date without signing it the date it was actually signed. So if I'm going to sign something December 28th, but I want it effective December 1 because it's just easier for cost allocations or contract arrangements or something, maybe that's okay. I don't know what the tax impact is as a generalization, but if I'm making it effective December 1, it better say effective December 1, signed December 28th properly. And this stuff, folks, comes up all the time. I just gave some comments to a client who had prepared stuff on their own because, of course, they didn't want to pay legal fees, and they had a whole bunch of documents, significant transfers, dated effective with no signature date. Smaldino says you can't do that. It's suspect. And here it was not only suspect, it looked like just fraudulent backdating because they had an appraisal done months later but made something effective before and they didn't date it. If you're going to date it effective earlier, sign it and have both dates and be honest about what you're doing. Jonathan?
Well, Marty, of course, I agree with all that. And don't let the client pressure you. As our dear friend Howard Zaritsky has said many times, don't make the client's problem your problem. So if the client comes in and says, I want you to date this back to December 1, you got to say, I'm not doing that, or we have to make it clear that even though we want it effective December 1, it's being signed today. And maybe you can come up with a theory about why it's effective on December 1, but you don't want to say, oh, we're signing this on December 1 when you're really signing it on December 28. I mean, you could really get yourself in a lot of trouble. In fact, you may even wind up with some sort of, fraudulent charge. Just don't do it. Don't make the client's problem your problem.
That's like the drug commercial, right? Just say no. Don't want to do it. All right, we're going to jump off Smaldino. Lots of good facts there, and lots of good lessons there, not good facts, good lessons, especially as to year end and step transactions and formalities. With the pressure of year end, if there's deals you're trying to get done, keep Smaldino in mind. You don't want to rush through something or, like Jonathan said, get pressured by a client to do something and miss critical steps. It's going to come back and bite the client, and if the client gets bit, it may bite you as well. I want to just take a couple of minutes, and Jonathan, let me just run through a few thoughts, and then I'll turn it back to you on the Levine case. I don't want to get into the facts of split dollar or anything else, but Levine had some really important statements about the way to do better planning, and I just want to kind of mention some of those using Levine as the context to do it, and especially because some of these ideas will be particularly helpful to bear in mind as we get to year end and you're rushing to get some deals done that are in the hopper. So it kind of presented a roadmap. One of the things that Levine liked, and it's going to get harder and harder to do this before year end, but you may be able to do it after, and you may have already done it, but if you have time, you should do it. The Levine court was very impressed, and it was a taxpayer victory. We're not going to go into the split dollar transactions, not relevant to our topic today, but they were very impressed with the sophistication of the family, the attention to details. They were impressed with the sophistication and thoroughness shown by the estate planners and the adherence to formalities, just like we talked about. They noted, and I'm on slide 24, that there's a good deal of time spent thinking through all the advantages and disadvantages, conditions and qualifiers of the plan. The attorney put together a PowerPoint to explain to the family what the planning was. Bottom line take home here, I think you want to be deliberate and careful in your planning. You want to document what you're doing. You want to show pros, cons, advantages, disadvantages, and options, because then the client's making a decision. Based on a number of the recent notable malpractice cases, I think getting the clients to options and letting them make a decision can be helpful to the practitioner, but it's also helpful to the client, as the Levine court said, because the care and the attention and the detail and the client understanding it, kind of the opposite of what Jonathan explained happened in the Smaldino case, all impressed the court. Another thing to keep in mind, and this is really important, especially as we get closer to 2026 and the reduction in the exemption, it's important in year-end and all planning, frankly. In Levine, what they did is they focused on transferring what was referred to, and you see it on slide 25, as excess capital. In other words, Mrs. Levine had enough assets and resources to pay her lifestyle needs. Only the excess over that was transferred in the planning. You have to be mindful that if you start transferring assets without any documentation what the client needs to live on, are you digging into what the client transferring, tying up what the client may themselves need to live on? You need to be mindful of that. It's not only mindful from supporting it from a tax perspective, but also from the client being able to be comfortable with the planning. In Levine, they were very careful, and we're not going to go through the details. There's lots of materials in the slides and other programs on the Peak, ILS, and Shankman websites, but the decedent had no rights, very important to keep in mind. Insurance planning, only the ILIT, only the insurance trust owned the insurance. There were no transfers back and forth. Independent person as a trustee. When you're putting planning together, my default preference, and it's not just an advertisement for Peak or any of the other good trust companies, I try to always use an administrative or independent institutional trust company. So if the client's got a relationship with a trust company, and there's lots of great ones, we use those. If they don't and they have other financial advisors, we may use an independent institutional trust company. Having independent people as trustees is really important. The court in Levine was very impressed that they used South Dakota Trust Company, independent institutional trust company, slide 30, very, very valuable. Different fiduciaries and different ends of the transaction. There's a lot more that could be said about that, but just keep that in mind when you're structuring year-end transactions. If we were doing a note sale to a trust and there was a spillover to a GRAT, whether you want to use a GRAT after the recent CCA or not is a different discussion we're not going to have. But I would have the GRAT have, let's say, be in South Dakota with one trust company, the trust that's making the purchase in Alaska, so that I have a different trustee, different jurisdiction, so there's independence across the board. If there's a spouse that's doing a separate trust, I'd have that perhaps in Nevada or Delaware. I like to have different trustees. They also point out that different beneficiaries of the different trusts gives it credibility. Slide 33 is a comment about something that should be obvious to everyone, but is often not addressed. One of the things the court was very impressed with on in the Levine case was that there was insurance on the life of the children made sense. There was a business and economic purpose for what was done. Jonathan, I don't think we want to spend too much time belaboring it, but do you want to make any comments before we get into trust income tax planning?
Well, a couple of things to keep in mind. Trusts reach the highest income tax bracket on the federal level, as Marty shows here, at $13,450. Next year, it's going to be $14,450. That's a very low threshold. Individuals don't reach that top bracket until well over $500,000. And one of the ways you normally can avoid having the trust pay the tax is making a distribution to the beneficiaries, or possibly to another trust for the beneficiary. Maybe it's a grantor trust, maybe a 678 trust, so it's taxed to the beneficiary. That's something to keep in mind. Fortunately, Section 663 of the code gives an extra time to determine how much of this year's income you want to have taxed to someone other than the trust. You have 65 days after the close of the year, and that's going to be, March 5th of 2021. But you need to call the group together. You need the lawyer, the accountant, and other advisors to sit down and say, what should be distributed from this trust? That makes great sense to actually do it, to make the distribution and then make the election under 663B to have it treated as though it was paid in the prior year. And you could determine, for example, maybe you have a beneficiary who's in a state like Florida or Texas where there is no income tax, and maybe you want to distribute it to that person. On the other hand, maybe you want to spread it around to a lot of people. And you need to get everybody together, because if you make a distribution of income to a beneficiary, that's going to change the tax profile of that beneficiary. And it's going to be retroactive to 2022. So, for example, the beneficiary needs to know, am I going to have to report more income? Did I need to make an additional payment in order to make sure I didn't underpay my estimated payments? So think that through, but that's a major opportunity that you have in order to reduce overall taxes. Also, keep in mind that you may wind up paying state income taxes if you wind up distributing distributable net income to a beneficiary who lives in a state like California, New York, Oregon, if they live in Philadelphia, where they have a high state or state and local income tax. So that's something that you really need to keep in mind, but you can call everybody together within the first 65 days of the close of this year to determine what income in the trust, if for this year, you want to be treated as though you distributed it in this year, even though you only pay it within 65 days of the close of this year.
An accountant that I know tells all her clients that it has to be by the end of February. And she does that because she just wants a few days of breathing room in March to take care of it. I think everything Jonathan said is really important. Just two quick comments. If you have the ability to communicate with the client, the wealth advisor, the accountant before the end of the year, get the ball rolling on this. I mean, there can be some fairly significant income tax savings just planning what Jonathan just explained. Second point, and it's the last point I'll add on this, is many accountants view their role with trust income tax as compliance, filling out a form 1041, just filling out the income tax return. Why don't you turn those compliance clients into planning clients? Reach out to them. If you can do it before year end, all the better. If not, you got the 65-day rule, and talk to the client and their wealth advisor and discuss this planning. What a great thing to get a client to save some tax dollars, and sometimes meaningful tax dollars, through a distribution or other planning that you might be able to do. So make those compliance clients into planning clients. I think the clients will love you for it, and it'll make things useful for you. Slide 37, just a quick comment. And there was recently, and Jonathan, you may know it, and I haven't been able to find it. Steve Akers mentioned a case. I don't have the name off the top of my head, and I couldn't find the case. We looked for it. That it may have already been resolved, but he talked about it in a current developments program he did, where the IRS was challenging a valuation adjustment clause on the basis that there was, and the IRS doesn't love laundry. They were challenging it on the basis that there was no economic adjustment provision. So in other words, if I gave or sold an LLC interest to a trust, and that trust, instead of getting the 50% I anticipated, got a $10 million transfer, turned out to be 25%, I would need an adjustment for distributions and income and so on and so forth that occurred from the date of the transfer to the date that we found out the gift tax audit results, and had to adjust from 50% down to 25%. So on slide 37, I've just illustrated part of an economic adjustment clause that I crafted to use for that purpose. Jonathan, do you remember hearing about that case?
Yes, and the IRS eventually backed off on it. So again, I think that laundry type clauses where you don't say I'm giving 50% or 25% or 82% of something, And because you think it's worth $5,000 or $5 million, instead you say, I'm giving $5 million worth. And you should do that by a fractional gift. You say, I'm hereby transferring to the trust that fractional share of this interest, the numerator of which is whatever you want the dollar amount of the gift to be, say $10 million or $100,000, and the denominator of which is the fair market value of the whole as of the date of this transfer. The Wandry case, which was essentially a unanimous tax court decision, said that works and the IRS has to respect it. And I like that better than price adjustment clauses personally. I've had very good success with it in audit. And now we have a case where, although the IRS initially told the taxpayers we won't respect it, they eventually backed off. On the other hand, there is a case involving a lawyer in Texas where she did settle the case, but I think that there may have been a little bit of stuff on the edges that wasn't good. There was a case, I can't remember the name, Marty, maybe you will, where they put in an adjustment, but it was based upon the appraiser's valuation.
Nelson.
It wasn't based upon, what was that?
Nelson, the Nelson
Oh, the
case.
Nelson case, yes. Rather than saying it's going to be, fair market value is finally determined for federal gift tax purposes, which is the phrasing you should use, they said as the appraiser determined, and the court said that does not work. So be very, very careful when you use one of these defined formula clauses where it's going to be based upon a dollar amount. Make sure it's based upon as finally determined for federal tax purposes as of the date of this transfer. That's going to really protect your bacon, I think.
And my preference is I like to build in an economic adjustment clause. It doesn't take a lot. I've actually just gone through some calculations with an accountant who made some adjustments because there was a valuation adjustment. I think it gives incredible credibility and shows incredible respect to the formalities of the transaction. If you like the idea, you have a sample clause on slide 37. Here's the Nelson case. Jonathan already told you about it. He beat me to it. There's a couple other valuation cases. I want to go through them real quickly, but just to point out the concerns. Jonathan, you want to explain the CCA on the GRAT CCA, and then we'll talk about Batty very quickly?
Yeah, this was a situation where they wanted to make a transfer and they basically knew that the value was not correct. They had gotten an appraisal and they waited a long time, and then they made the transfer and they said, we're going to use the value determined as of the date of the appraisal rather than the date of the transfer. And the Internal Revenue Service was so upset that it wouldn't respect the grantor retained annuity trust. Now, they had drafted it exactly as the regulations indicate, but because they had so abused the system, they said it wasn't a good grantor retained annuity trust. And if the service could make that stick, it means that not only do you get a change in value, it means that there is no value prescribed to the annuity, which means the entire amount transferred is immediately subject to gift tax. You don't want to do that. Look, you can do so much in the planning that you don't want to try to abuse the system. I mean, get your appraisal on the date of the transfer. Don't get it even a month ahead of time. And you just get one as of the time of the transfer. Just don't do that. And otherwise, you're going to have the Internal Revenue Service very upset with you. And that's never good.
What the taxpayer did here that I think reasonably irked the IRS, they were shopping the company. I think they had 5 offers on the company, and the appraisal value they used was 7 months earlier. Now, I don't know that, a lot of people say it has to be the date of the transfer, 30 days, 60 days. I think the answer is, and now I'm really a lawyer, it depends. If there's really no substantive change in the underlying economics of the business or the economy, which is a big if, but if there isn't, I'm less concerned with the dating of the appraisal if it's reasonable. But here they knew there were significant, material, dramatic intervening events, and they didn't address it. Had they only had the appraisal that was done earlier updated and had the new updated appraisal reflect the reality of the offers that they were receiving, whatever the consequences were of that, I think it would have been a very different result. But as Jonathan said, they were like pushing the system. And by the way, if this sounds, oh, that never happens. I just had a case like this with a client. they they were trying to make a transfer, and it actually worries me. The appraiser, the business entity appraiser, appraised the LLC interests that were to be transferred, and the business entity appraiser, he relied on a 7-month-old, just like in the CCA, under appraisal of the underlying real estate of the building. But that building, between the date of the appraisal of the underlying property and the date of the gift they thought I was going to make, which I refused to do, they tore the building down, started construction on a new building, and signed a lease with it like a credit quality tenant. Hello. I mean, that's not the same economic arrangement whatsoever. So I insisted they get a new appraisal from a new MAI appraiser of the underlying property, and reflect and expressly mention the status of the construction and the lease. It turned out, which is fine, that the value didn't increase all that much because there was just a whole litany of contingencies about that lease. That's fine. But the IRS can't say we didn't have it addressed or that we were hiding something. It's now been addressed. So be careful. This stuff is real. It's not just, oh, that's a crazy one-off case. Now, in the Batty case, it was a similar kind of concept that somebody was the chairman of the board, and they were aware of offers on the company, but they used the fair market value of the stock. Now, I believe the Batty case was settled or withdrawn, and the question there, and Jonathan, you can feel free to elaborate, the question there was, do you impute, it's a hypothetical willing buyer, hypothetical willing seller. If you have a specific seller that has insider knowledge that they're legally restricted from even using, is that really what a hypothetical buyer would note? And I think the IRS backed off on it. But again, the point is, if there's significant facts, you really should evaluate it. Jonathan, any comments on Batty?
Yeah, well, in Batty, they were giving away marketable securities. And of course, the regulations under Section 2512 tell us that the tax value of marketable securities is the average between the high and the low on the date of the transfer. So if the high is 100 and the low is 90, the gift tax value is going to be 95. And that's what they used, even though they knew that because they had to some degree been shopping it, that it could turn out that the company would sell for a lot more. And the IRS was going to go to court about that. But that's over 100-year-old regulation. And it's very, very difficult unless you're dealing with, say, someone who controls, more than a small amount of the stock. So it's just too big a block in order to use the average of the high and the low. And in fact, the regulations under 2512 tell us that you may have kind of a blockage discount or maybe a control premium if you control basically what's going to happen. But they apparently, the government backed off on this because I think they felt that regulation is so old. It's been used over and over and over again, the high and the low. In fact, you might have a client who says, gee, I want to give some of my Tesla stock to my kid. Well, maybe you want to give it on a day where the closing value is basically, different than what the average is. So if the closing value is higher than the average, maybe you want to give it away that day. Because say, the high is 100, the low is 90, the gift tax value is going to be 95. But if it's worth 100 at the end of the day, maybe that's a good day to give it away because you get that extra 5 points up as part of the gift. Now, that rarely happens in the real world, but it could happen. So I think you have a safe harbor there if you use the average of the high and the low of the trading prices on that day. Again, unless you have such a small amount that it can't be used or such a large amount that it's going to affect the price.
Interesting comment. I haven't heard anyone point out. I just thought of it, so you can feel free to shoot me for it. But if you don't agree, but it's interesting, the IRS in a recent case that I believe is on appeal, and I'm blanking on the name. I could look on my laptop and find it in an instant, but I don't want to mess up the screen. There's an insurance valuation case, Ashar, which is a well-respected insurance company that does sales into the secondary market of insurance, did an appraisal of a life insurance policy that was given, I believe, without a valuation adjustment clause. And I don't know why they would not have put that in. but it was transferred to a trust. And the IRS came in and said, no, you can't use the fair market value based on the secondary market, which is a robust, independent market for years now. Rather, you have to adhere to the requirement in the regulations to value an insurance policy based on, I think it's the interpolated terminal reserve value under the regulations. So it's interesting that in the Batty case, the IRS is saying the regs, we're going to argue that you need to consider fair value, but in the insurance valuation case, which I think is still pending or on appeal, are you familiar with that case, Jonathan?
Yes, I am, but keep in mind that the regulation on the value, on the gift tax value of a policy of insurance, which is 2512-6, I believe, goes ahead and go ahead and you take the interpolated terminal reserve. The interpolated terminal reserve, by the way, is what the insurance company has on its books as its potential liability on that policy. And they try to mark it up as any company would know, what is our potential, liability here. So they try to figure out when that person will die, what they would have to pay, and so on. But the regs specifically state you do not use the interpolated terminal reserve if it doesn't really reflect fair value. So in a circumstance where, we know it's going to have a different value than what the interpolated terminal reserve was, I think that's what you've got to use. And this comes up from time to time where, you've had a policy for a long time, it has some cash value. Maybe the person is got some kind of illness, which means that that person is going to die soon, which makes the policy much more valuable. Now, there's only one case out there, and that where death was pretty imminent, but it could happen at any time. So don't think, oh, I'm golden, I have the interpolated terminal reserve. Yeah, the insured has got cancer, but he's probably going to live for a couple of years. You've got to be very cautious in that place. And in fact, I would think you'd want to get an appraisal. You wouldn't just want to write to the insurance company, tell me what the interpolated terminal reserve is on your books, and then use that to make the gift tax valuation. You can do it if you make all the disclosures, because keep in mind, if you don't disclose fully, you can be subject to valuation penalties. And if your client winds up facing a valuation penalty, your client may come back to you and say, hey, Marty, I was doing this. I don't want to have to pay this penalty. I think I want you to pay it because you were advising me. So again, protect yourself. This is something Marty and I really believe in. Protect yourself. Tell the client to do the right thing.
Yep. We're going to talk about that insurance case because that's interesting. And anyhow, let's get on to another topic. So Jonathan, let me tell you why I put this in here. If you recall way back in 2020 and 2021, which seems like a lifetime ago, we were lecturing like almost every other week on whatever the latest, greatest proposal was in Congress, because it seemed like every couple of weeks they had a new proposal. And one of the things that we talked about in some depth back then was the tax construct of rescission. And we did it because, gee, what if you did a transfer to a trust and the Von Hollen or Pascrell bills were enacted, and retroactively, I forgot if it was Van Hollen or Pascrell that was retroactive, maybe, I think it was just one of them, but they were proposing retroactive tax changes where you could make a transfer to grant or trust and bam, they'd have a retroactive January 1, you would have just triggered gain. So we wanted to give clients a mechanism to unwind that transfer and avoid an unintended capital gains tax. So we talked about the idea of rescission. I don't remember ever hearing anyone talk about rescission in a year-end planning presentation, but boy, I think it's important. We should have it in every year-end planning presentation, because if it helps unwind a transaction somebody's unhappy with from that year, from 2022, if you do it by the end of the year, I think it could be important. You want to talk a little bit about rescission just to make sure people have it on their radar?
No, Marty, this is very, very important. Really, there are two factors to rescission. One is, does it work for gift tax purposes, and does it work for income tax purposes? And Marty has down here a case called Penn versus Robertson, which is then reflected in Revenue Ruling 80-55, where the IRS basically said, if you do it within the same year and you restore the people to where they would have been had the transfer not occurred, we will respect it. You can basically undo it. Now, that was in an income tax context, but it may work also for gift tax purposes as well. And you can even go to court and try to get a rescission. Basically, we made a mistake. And in many cases now, and this was a case that came up in Massachusetts, whether it's a mistake of fact or a mistake of law, if there's a mistake made, you can undo it. And the IRS, or at least one district court, has said, we will respect that. So that's one of the things to think about. In addition, when you're thinking about rescission, consider a disclaimer. For example, maybe I create a trust for the benefit of my spouse, and I can set that up in two ways to undo that. Number one, I can make it a Q-tippable trust, and maybe I just won't Q-tip it, which means that it's going to use my gift tax exemption, or I may wind up paying some gift tax. If I, so I go ahead and if I do Q-tip it, it's going to qualify for the marital reduction. And if I trust my spouse, maybe I can go to the trustee and say, look, I created this Q-tip trust for my wife. Why don't you invade, give her the money, and maybe she'll consider giving it back to me. So that's two ways when you're dealing with a spouse that you can do it. But even if you're dealing with children, you can do it. Moreover, there are cases which indicate that if local law permits it, and for example, Alaska does, and I believe there are other states that do, you could even have a trust and have the trustee do a disclaimer, basically do a rescission and give it back to you. And that's a lot better, I think, than giving something directly to the child and then saying, well, I want you, things have changed, maybe the valuation is different, maybe a lot of things, maybe the law is going to change. We want you to undo that by doing a disclaimer. Well, if the child has already accepted directly, it's much more difficult. If it's gone into trust, you have two options. Option number one, the child can disclaim her interest, and if you set it up properly, so I say, if my son Jeffrey disclaims his interest in this trust, everything is undone and it will revert back to the transferor. And you can do that, or if you're in the right state, you can have the trustee do the disclaimer, and that way you undo it. But you really need to think through those things when you're making these transfers, because it may turn out in a few months that it's different than you think it was. But don't give things directly to people for a variety of reasons, including that it's much more difficult to have any sort of disclaimer which will be respected under Section 2518 of the code, because you may have acceptance by the person who actually physically received it.
Isn't there a more important reason that all gifts should be made to trusts?
Of course, Marty. Of course.
The lawyer won't be able to bill.
Every transfer.
The lawyer won't be able to bill, Jonathan.
Every transfer you make should be in trust. Every single unless it's, maybe you're doing something small, the kids are going to spend it right away, they're going to go on vacation. Any significant transfer ought to be in trust. That's an absolute, Block-Macher, and I think Shankman rule. You just don't give money directly to people, not only because it could be, attacked by that person's creditors, but it's also because you can more easily undo it and you can more easily protect it. So if it has to go outright, you can do that. Very easy to get assets out of a trust. But in order to get them in and get the protection of trust, you have to start almost always with an in trust to begin with.
Two take-home points, folks. Planning year-end trust transactions, and frankly, planning any trust. I'll be careful. I guess the question is, what harm is there building in a disclaimer structure or mechanism? Like Jonathan said, it gives you a chance to unwind the transaction. There are some that feel that if you have a mechanism like that, the gift may be incomplete. We're not going to go there now. We got too much else to cover. But consider building in a disclaimer mechanism so that you can unwind the transaction. Second take-home point. When you're talking to anybody about year-end planning, before the end of the year, even the day before, even up to the very end, mention the idea of rescission. Are there any transactions you did that there may be a benefit or reason to unwind? We can possibly do it if we take action before year end. I don't think that's on enough year-end planning radar screens. Usually you see the same, make your charitable donation and your IRA contribution and so on and so forth. It's usually the same stuff over every year, year. I think this is a great idea for a small number of clients, but it should be on the radar screen of all planners to talk about. Let's go on to our next topic. Jonathan, I don't want to spend too much time because we got really important year-end planning stuff, but just take a couple minutes and explain succinctly what the Welland case is, and just as a lesson for people of what they want to think about as they do planning, especially for year-end.
The Welland case is a fascinating case where a law firm recommended a variety of steps for a very wealthy client. And one of the things that it recommended is that they do basically a freeze type transaction. And as it turns out, it would have been an absolute grand slam home run where they got a tremendous amount of property out. They put it into trust, and the person who was the beneficiary wanted it, obviously, but they decided at the end of the day that they were going to basically have it basically treated differently. And so they had a situation where they, put it in a trust, and it was a grantor trust, and it was a huge amount of property. It was Berkshire Hathaway stock, and then the stock was sold. Now, the basis of the stock was very low, and as you know, when you transfer something to a grantor trust, there is no gain. But now any income that's earned, including gain, is going to be taxed back to the grantor. Well, that's one of the benefits of using a grantor trust, because the grantor, wind up paying the income tax on the assets in the trust, whether it's ordinary income or whether it's capital gain. And that means that basically those assets never are subjected to tax, and I reduce my estate by the income taxes I paid without being deemed to make a gift. What a wonderful thing to happen. Well, that happened in the Welland case. But Mr. Welland took the position that he didn't understand, that no one had explained to him that he was going to have to pay income tax on the income that was generated when they sold the Berkshire Hathaway stock. And it was over $100 million worth when the trust sold it. Now, from the perspective of his children, that was all wonderful. But there were some additional complications. Mr. Welland, I believe, was in a second marriage situation. The trust wasn't for his wife, it was for his kids of a prior marriage. And as a consequence, maybe she wasn't very unhappy, because even if she felt, well, you make the gift, there'll be enough for me, because he had to now pay the income tax, maybe there was less for her. And what happened is that Mr. Welland wound up suing the law firm. Now, the case is a reported case, but it's very interesting because Mr. Welland complained in his case that no one told him he was going to have to pay the income tax. Well, I found out from the lawyer involved that no one wound up paying the income tax. The IRS apparently just dropped the ball. So even though, the law firm wound up being sued, even though Mr. Welland claimed that he had been injured, in fact, he wasn't, because the property was sold. He didn't pay the tax, even though it was a grantor trust. And maybe they were relying, Marty, on that case called Rothstein, which was a Second Circuit case where the Second Circuit Court of Appeals in New York said a grantor trust is not disregarded. Now we know the official position of the IRS is reflected in Revenue Ruling 85-13, says it's disregarded. The grantor is still treated as though he or she owns all the assets in the grantor trust. But maybe what they said, because they did this in Rothstein, they said, no, it's not a disregarded entity. And maybe that's what they did, saying, well, I don't care that it's disregarded or not. I'm just not going to pay the tax. That would be a hard thing to convince anybody, because the income of a grantor trust is attributed under Section 671 to the grantor, even if it's not completely ignored, as Revenue Ruling 85-13 reflects. So in any event, I have it on pretty good authority. No one paid the tax, so it was a grand slam for everything, except that the lawyers have been sued, and I don't think that lawsuit has yet been resolved.
So a couple take-home points. First, I'm going to quote Howard Zaritsky again. He says all the time, clients have very selective memories. They remember kind of what they want to remember. The only way to really protect yourself, and I'm not saying it's a standard of practice, is to put it in writing. Lots of us colleagues, lots of practitioners feel awkward. I don't want to put in writing the risks of the transaction, because what if the IRS sees it? I think you have to, let me rephrase that because this is recorded. I think you should, I'm suggesting, to protect you as the advisor, whether you're the attorney, accountant, wealth advisor, it doesn't matter, put in writing some of the risks of the transaction, and whatever risks you inform the client of, say this is some of the many risks that we discussed, because you're going to discuss lots of them. And if you collaborate with all the advisory team, there's going to be other advisors bringing up other risks. Put it in writing. If you're getting time pressured because of getting deals done by year end, make a note on your calendar, January 2nd, 3rd, 4th, whenever you're back in the office, to follow up with those clients and said, dear, Smith family, we did a gift, a note sale, or whatever, in the waning days of 2022. And I just want to document, so you have a record for your reference, some of the many risks that we talked about. So if you can't get it done because you're pressured to get all your deals done by year end, make a note, follow up quickly after year end, so that you're confirming while the client remembers and you don't forget to do so. It's unfortunate we have to view practice that way, but I think protecting us has got to be part of every year-end planning webinar going forward. Now, Jonathan, this is one of the hearts of what I want to talk about, this and the annual gifts. So we all know, and we don't have to go through it, the exemption is to be cut in half in 2026. It was part of the 2017 Tax Act. It was baked in, and the exemption is going to go from almost 13 million in 2023 to call it 6.5 to 7 million in 2026. So we're going to all see tons of clients scampering. And if 2012 was an example, and I think unfortunately human nature hasn't changed since 2012. In 2012, we all saw all the allied professions saw tons, tidal wave of clients coming into the office, like starting in October, maybe September, but much of that planning was done towards the waning days of 2012, because we thought the exemption was going to go from 5 million to 1 million. Everybody waited to the last minute. Not a prudent way to do it. Let's take that and then talk about what we might still do to make planning even better and safer for our clients in the waning days of 2022. So Jonathan, if I were going to set up a SLAT plan for a married couple, and I'm going to ask you a question, so don't answer the main question. The main question is, what might I want to do in 2022 to make it safer before 2025 ends? Why do something this year? But before that, and forgive me, I know we've talked about this on other programs, but it bothers me. There have been some colleagues that have come out with some articles and webinars saying how SLATs, non-reciprocal SLATs don't work, blanket don't work the way most people do them, and bashing a concept that frankly it seems like most of the industry has done not a little bit of, but a lot of. Do you want to just comment on that, and then let's talk about the 2022 year-end planning?
Well, any such contention that a spousal lifetime access trust doesn't work means that whoever says that is really uninformed. You can create a trust for your spouse. It may well be a grantor trust with respect to you. And one of the things you need to consider for yourself or for your clients is, what are we going to do if the spouses depart or get divorced? How are we going to keep the grantor from having to pay the income tax on a continuing basis? And you can either put in what's known as a floating spouse clause, which means I'm not going to make it for my wife, Betsy, but I'm going to make it for the person to whom I married at the time in question. Now, if my lawyer did that and showed it to Betsy, she might say, what do you mean it's not always me? Well, Betsy—
my wife wasn't that nice about it.
Well, but I can say, look, I always want to have indirect access to this. So if you die, God forbid, right, but if you die and I remarry, I want to continue to do that. But that's something that you need to do. But there's no question that you can create a trust for your spouse. That trust will not be includable in your estate unless you retain certain powers or interests in it. Now, Marty mentioned the reciprocal trust doctrine. The contention that some people have is, oh no, it's always understood that you're going to get it back. But there are some things you can do about it. For example, if I create this trust for my wife, I'm not going to tell her that I want her to give it to me when she dies. In fact, I don't even give her a power of appointment to continue it to me. But maybe I will go to the trustee and say, when I created this trust, I didn't give Betsy a power of appointment exercisable upon her death. But would you consider doing that under a decanting, for example, which you can do in virtually every state which has a decanting statute? So, I go to Marty, who's the trustee of that trust, and I say, would you give Betsy a special power of appointment so she could appoint it back to me when she dies if she predeceases me? And Marty says, I can consider that. In fact, what Marty might do is to say, Betsy, I'm going to give you this special power of appointment, but you can only exercise it with my consent or the consent of another independent person. That way you're going to be protected from all ends. So that's, one of the things you really, really want to consider in doing it, but there's no question that you can do it. You can use the big exemption because the assets are now in a trust for the benefit of your spouse. And as long as you're happily married, or whoever is the spouse, because we're going to define it as the person to whom Jonathan is married to at the time in question, I can continue to enjoy it. And unless the IRS can show an understanding that it was going to come back to me, there's no way in the world that they're going to be able to contend that it's really my property. The other thing, Marty, we've talked about is don't just do two slats. In fact, Marty and I have talked about if Marty's doing one for Patty and Patty's going to do one for Marty, separate them in the following way. Different jurisdictions for the trust, different trustees, different standards for invasion and payment. One spouse has a broad special power of appointment, the other one doesn't, and use different assets all the way across the board. But there's something even better, and that's the SPAT, the Special Power of Appointment Trust. So I create this slat for Betsy. What Betsy doesn't create a slat for me, she creates a trust for the benefit of our family. And it specifically says that the trustee can never make a discretionary distribution to Betsy and can never make a discretionary distribution to me, even if the trust is amended or decanted. But what Betsy is going to do is to name 3 people we trust and arm each of those people with a non-fiduciary special power of appointment, which can be exercised in favor of any descendant of mine or of my mother or of Betsy's mother. I'm going to be in that class. Betsy's going to be in that class. And that's going to mean that now we can have access to all the property. That's really something to consider. Yes, you can do non-reciprocal slats, but I think this concept of SPAT, Special Power of Appointment Trust, is actually safer. Have one be a slat you want, just a regular slat you've created for your spouse, but have your spouse then create a SPAT, a Special Power of Appointment Trust. And if you want to read about that, there's a great article by 3 of my mother's favorite authors. That's Mitchell Gans, Abigail O'Connor, and me in the February 2019 issue of Estate Planning Magazine.
So, take home point, despite some of the really very negative articles about slats, it's not that the concept doesn't work. Is there risk? Of course there's risk. Of course there's risk. Second, apropos to year-end planning, we're getting tight in terms of how much time is between now and the end of the year. That being said, if you have a trust in process in the hopper or can get one in the hopper quickly for clients that are talking, I think getting a trust completed before the end of 2022, even if you can't make every decision and you decant it in the future, that trust is now a 2022 trust. You could even wait to 2024 or 2025 to do the second trust. Why not get one done if that's feasible? Second point, and I think this is really important, and this goes back to the Smaldino case, which is why we talked about it earlier. This is 2022. It's not quite over yet. Let's say husband, for argument's sake, has all the assets in his name, and I'm using the pattern of the Smaldino case, and he wants to give his wife a chunk of money that she may then contribute to a slat, spat, hybrid, DAPT, or DAP, some type of trust that may benefit the husband. Why not make that gift, those transfers from husband to wife this year, and get it done in the current tax year so that you have more tax years that pass before the wife, who's the donee of the gift from the husband, makes a transfer to a trust? I even like the idea, do it this year, wait till well into 2023 or even to 2024. I like even better reporting that spousal gift on a gift tax return so you're totally upfront about the retitling of assets. You have to make a taxable gift, or I think you should make a taxable gift so you have a basis for filing. I don't know if you need to, but I would make a taxable gift of some modest amount, 17,000 because the exclusion this year is 16. File a gift tax return and report the gift. You only have to technically report gifts to a non-citizen spouse or a Q-tip gift to make the Q-tip election, but you can report as a transaction, a transfer from one spouse to another. Why not do that? Document it. Too often clients wait to too close to the actual planning before they retitle assets. If you have assets in a couple's joint name and they're going to each want to contribute over the next year or so to different slats, spats, DAPs, hybrid DAPs, or some combination thereof, why not divide the assets this year? Now, even better than just dividing the assets, because one of the factors, and I'm not sure Jonathan mentioned, he gave a whole long list, but one of the factors is separating the transactions by time. And one of the problems is if you want to break the reciprocal trust doctrine, different tax years and more time between them is a good thing. If you want to break a step transaction doctrine, which is really another doctrine independent of the reciprocal trust doctrine, get time and tax years between these transfers. So that is something to me that's a different perspective on this year end. It's not that you have to have all the gifts completed, but anything you can do now, pre-planning for 2026, I think gives your client a better position to be in terms of trying to deflect a challenge by the service or the creditor as a step transaction or reciprocal trust doctrine. And I like the idea of reporting and documenting an interspousal gift. Let me do another topic. One of the things, if you're trying to get a transaction done by year end and you can't get an appraisal in time, you can make the transfer based on an appraisal to be received. I want to just tell you one of the approaches I've used when we've had a transaction we want to get done, let's say for a sale, and we don't have the appraisal in yet. I've used what I dubbed a two-tier King price adjustment. King is a 10th Circuit case. Jonathan beats me up every time I mention it because he says Wandry's a full tax court case. Why are you talking about King? Forgive me. But in the King case, let's say they sold $25 million interest in a family LLC to a trust for a $25 million note. But the face value of the note didn't say it's $25 million. It said the note value is nominally $25 million, but it'll be adjusted upward for a gift tax value finally determined. That's the King case. What if you made a two-tier adjustment? We hired MPI, Empire, Stout Reeses, whoever, whatever appraisal firm, name the firm if you can, to do an appraisal and get them hired this year. And what we're going to do is adjust the note up or down from that 25 million based on the independent appraisal. And then there'll be a second adjustment if there's a gift tax value finally determined to adjust the note upward from the appraised value to that. It's just another mechanism to try to complete a transaction where you're getting pressured on time to get something done before the end of the year. Jonathan, let me just run through a couple quick points because I want to get to annual gifts and give you some time to talk about that. And I want to add some comments because that's critical for year-end planning. You can use other shortcuts. You can use a home state trust. So if you're in New York, you may have no choice. You can't get it done in Nevada, South Dakota, Delaware before the end of the year. Do a New York trust. I don't love that because now it's on the radar screen in New York. You have the New York rule against perpetuities, which is shorter than, say, the Alaska rule. But you may have no choice if you're trying to get a transaction done this year and then later have a trust protector next year move and change the situs. You could have a joinder agreement instead of trying to redo a partnership or operating agreement. You can rely on a further assurance clause for some of the ancillary documentation. Let's skip through this. Jonathan's already mentioned some of that. And what I'd like to do is let's skip the clawback regs unless we have time to come back to it. Jonathan, year-end gifting is always talked about before year end. Right now the annual exclusion is 16 grand. It goes to 17 grand next year. Talk to us about annual gifts. Talk to us about the GST implications. And if you want, you or I, one of us should talk about really rethinking, do we even want an annual gift? Because for a lot of clients, it may not make sense, even though we've been doing it forever. So we have about 15 minutes left. Let's talk about annual gifts, because that's really a critical year-end planning idea.
Well, the annual exclusion, I think, is exceptionally important. I've been using it for years for my family. And one of the things you can do is to have it transferred to a so-called crummy trust, where you get the annual exclusion because you give the beneficiaries the right to take the property out. And the crummy case, decided by the Ninth Circuit in 1968, and the IRS has accepted it. If you give the beneficiaries the unilateral right to withdraw the property from the trust, even if they don't withdraw it, and even if that power to withdraw lapses after a period of time, there's case as short as 15 days, but I've never used anything under 30 days, and make sure they know about it, and it lapses, it's going to qualify for the annual exclusion. Now, that may not seem like a very big deal, but it is a big deal. Let me just give you some numbers. If I'm married and we have 2 kids, and each of those kids is married, and they have 2 kids each, that's a total of 8 potential recipients of annual exclusion gifts. Well, if you take $16,000, which is what Betsy and I can give to each, 16 times 8 is $128,000. And then if Betsy also makes annual exclusion gifts, that's $256,000. In 4 years, that's over $1 million, and that doesn't even count growth or income that is earned. And that's a really powerful thing to do. And a couple of things about that. Number one, say, well, suppose I need that money back. You're talking about an awful lot of money. Well, as Dick Covey pointed out after the Alaska Trust Act passed, you can put yourself in as a discretionary beneficiary. And if you do it in Alaska or one of the other 17 states that permit the creation of domestic asset protection trusts, where you create a trust in a jurisdiction like Alaska, South Dakota, Delaware, Nevada, New Hampshire, and a number of others, it will not be subject to the claims of creditors unless the creditors can prove that you have put the property in there to try to hinder, delay, or defraud your creditors. And by the way, I met with the bankruptcy judges at their annual meeting after the Alaska Trust Act passed, and they all stated, or some didn't speak, but those who did said, if you could establish that you were making those gifts to this trust for estate planning purposes, and you just wanted the eligibility to be able to get that property back if you needed it, we are not going to contend that that's subject to the claims of your creditors or is in the bankruptcy estate. So that's very, very important. So when you're doing something like a crummy trust, think about if you're going to do it in one of the domestic asset protection trust jurisdictions, and you've got to think about, well, is there going to be income tax on that? For example, you can do, a domestic asset protection trust in Connecticut. Well, that's fine. In fact, Marty was thinking about moving to Connecticut, and he was thinking about doing it in Connecticut because it had asset protection trust. Well, you could do that. But does that mean that you're going to have to wind up paying Connecticut income tax? Because Connecticut has a pretty snappy income tax. The answer is no, because you're going to make that grantor, that trust, a grantor trust, which means the grantor has to pay the income taxes on it. And that has 2 very good effects. Number one, the trust is going to meet the highest tax level, as we were talking before, at about $14,000 of income. Whereas if it's going to be attributed to an individual, it's probably going to be much less. So that's one of the advantages. And the second advantage is you can be a beneficiary and with an independent trustee. And if you have a need, you can get it back. So when the client says, well, gee, giving away $250,000 a year because I have 2 kids and 2 kids-in-law and 4 grandkids, 2 from each child of mine. Wow, that's an awful lot to give away. What if I need that? Well, if you need it, it's okay because you're going to be an eligible beneficiary of that trust. So that is a very, very good deal for you. In other words, you're going to have asset protection. And again, you're going to be able to establish you were not doing this to try to bilk creditors. You were doing it to do very, very good estate planning. And then you're going to go ahead and say, and yet you're going to wind up paying the income tax, which means under Revenue Ruling 2004-64, that's not a gift where you pay the income tax on the income which that grantor trust generates. Now, I talked about you have 8 donees. You have your son, your daughter, their spouses. What do you mean their spouses? I don't want my son-in-law to get money. I don't want my daughter-in-law to get money, but you can make them crummy beneficiaries, and yet you can assure that the money is going to stay in your family line. How do you do that? You use an extra crummy trust. The extra crummy trust is actually discussed in detail by an article by Michael Graham and me in the 2008 July-August issue of Probate and Property magazine. If you want a copy of it, you can get it on the ILS legal forum there. ILS also has a good form of extra crummy trust, but it's a great trust for the following reasons. Number one, you do one trust at one time. And yet, as the number of descendants increases, if your spouses get divorced and remarried, or if a descendant gets married and you want to include that spouse, you can go ahead and do it. And you have only one trust to deal with. And as long as it's a grantor trust, you don't even have to file a tax return. And yet you can have those annual exclusions qualify for the GST annual exclusion. Now, we all know you can give, as Marty said, $16,000 this year, $17,000 next year under the annual exclusion, but there's no direct annual exclusion for generation skipping transfer tax purposes. But what will happen is you will get automatic allocation of GST exemption when you give it to a skip person like a grandchild. So you can call your grandchildren around and, at Christmas time or Hanukkah and give them each a check for $16,000 or $17,000 or whatever you're going to do. And you can also do it in trust. And in fact, if you take a look at section 2632, it says if you give a gift to a trust, even if you have a non-skip person like one of your kids, as long as everything is limited to the annual exclusion amount, you don't have to make a special allocation. You're automatically going to have GST exemption allocated. Keep in mind, even though you have one trust, every transfer is going to be treated as though it's made to the person who has the crummy power of withdrawal. It's not treated as though it's come to the trust. So again, if you don't want to, you don't even have to file a gift tax return. Now, it may be good to do a gift tax return to get it down, but you'll have one trust, one account. It's very, very simple. And my clients loved it because we did one trust one time. We didn't have to, every time there was a new grandchild, we didn't have to do a new trust. And the property remains in trust basically forever. It's not like a 2503C trust where it's supposed to come out at 21, or a Uniform Transfers to Minors Act where it's going to come out at 21. Some states you can keep it to 25. You don't have to do that. It's going to stay in trust forever, basically, protecting the property from the creditors of your children. And again, if you want it, you can also be a discretionary beneficiary of that trust. Now, you've got to be a little careful here on how you draft it to be able to put the grantor in as a beneficiary. Maybe what you do is you want to delay the time that distributions can be made by the trustee back to the grantor. And if you do that, you can get that automatic allocation of GST exemption under section 2632. Now, be careful when you read that. You're going to take a look and say, wait a minute, this doesn't fit under there because of the definition of a GST trust. If you make a transfer directly to a skip person like a grandchild, or you make it to a GST trust, you have an automatic allocation of GST exemption. But you say, but wait a minute, I've now given, my kids a right to withdraw property from the trust. Well, that's okay, because the 2632, I think it's C, says, if you limit the amount that can be taken out to the annual exclusion, then it's going to be a GST trust, even though your kids who are non-skip persons are eligible beneficiaries of the trust from the beginning. So you can kind of have it all. Use the annual exclusion. You can get a tremendous amount of property out of your estate. You will have asset protection for your family and for yourself, and you can be an eligible beneficiary of it all. So that's really what you want to do.
I encourage you to have a gift tax return filed and make a statement for GST purposes succinctly. It'll be a little longer with regulation citations, but something to the effect of, hey, I believe that name the trust is a GST trust and that automatic allocation covers all transfers to the trust. If it's not a GST trust, then I hereby affirmatively allocate enough money pursuant to a formula. You just want to be protected. And I actually like to go even a step further because it gets very confusing trying to track what was done, what was not done. I'll attach a statement and list all the different trusts of the client and say what the status is for each of them to avoid any ambiguity. You go back and look at a gift tax return, you know what's going on. The other thing, and I see this missed a lot of our clients have a lot of trusts and there's big bucks being transferred back and forth. What happens if you make a transfer to 2 trusts, for example, and you think that you want GST allocated to both, but you end up with a valuation adjustment? There may not be enough GST to wipe out all those gifts or protect all those gifts from GST. I will list a priority for how the GST should be allocated. So if there's an adjustment, allocate to trust 1, and only if there's GST exemption remaining after the allocation to make trust 1 fully exempt, then allocate to trust 2. Otherwise, if it's vague, I think you're going to end up with 2 trusts that have an inclusion of more than 0. Let me talk a couple other things with some of the time we have left about annual gifts. First, and I'm not telling you anything you don't know, but boy, I see it just ignored too often. Clients mess up annual gifts routinely. What do they do? They'll write out a $16,000 check to a trust for a kid or however many trusts. They ignore the fact that they took the kid on a cruise for 20 grand. They ignore the fact that they wrote out a check for 10 grand to help the kid buy a new car. They forget this, that, and the other thing. Protect yourself by documenting that you've asked the client to disclose to you all gifts so they can be properly reported. Client doesn't tell you, I don't know that there's much you can do, but you don't want a situation where the IRS comes in and, you know, some of these big numbers that clients just boom, boom, write out, they're not hard for an agent to find on an audit. You don't want the client to come back saying, well, why did you make these allocations? Why didn't you tell me? Document it. What I've seen done, and it's really the right way to do it, is the accountants have often had to create a spreadsheet showing all the transfers sequentially, chronologically, to for each beneficiary, because depending when it was made, you know, the client may have made a gift to a trust but already used up all the annual exclusion before they got to that gift. So you got to kind of lay it out and document it. Another point.
Marty, one other point, and I've seen this happen a number of times. It's the end of the year. You say, well, I'm going to give this year each of my kids and my grandkids $16,000, and then next year you're going to give them $17,000. First of all, it's best because of the time use of money to make the gifts as early in the year as you can. So if you're going to make annual exclusion gifts next year, do it in January. Don't wait until the end of December, although almost everybody does. But you've also got to remember that if you're going to make the gifts by check, that check has to clear before the end of the year. So if you want to give, you know, 10,000 or 15,000 to each of your kids and grandkids, and, you know, you're going to have a holiday either for Hanukkah this coming Sunday or Christmas the next Sunday and give away these checks, you better make sure you have cashier checks. Don't write them out, because the IRS has been successful in taking the position that because you could stop payment on those checks, the gifts aren't complete this year.
Good point. So let me make a couple other points about annual gifts. And the take home of what I want to explain is it's not one size fits all. And too often we like simple rules, right? We got a bunch of kids and grandkids. Let's write annual gifts out. It's a great way we've always done to reduce our estate. Maybe, maybe not. So first of all, we have clients that have 40, 50 or more descendants. When they start writing out these annual gifts, the numbers are just shockingly big. It's 16 grand and next year it's 17 grand. So even if they've used up their exemption, the size of their estates is such, annual gifts can move $500,000 or more. It's a big number. And over years, it adds up to a huge number. So for clients like that, it makes a world of sense. There's a good number of clients, and I apologize, I don't like the phrase, I'm not sure what terminology to use. I'll call moderate wealth. Client where 20 or $30 million is moderate relative to a $13 million exemption. And that touchstone, that analysis will change after 2026 perhaps. But if a client's worth $30 million, should they be making annual gifts? Maybe yes, maybe no. But I think it's worth a thought process and a discussion with the client. Why yes? Because, hey, it's a great way to move money out of the estate. But too often, it's done because it's what they've always done. Yeah, we always made annual gifts. When the exemption was $1 million and you could give away a couple $100,000 a year using annual gift exclusions, that was a phenomenal plan. It was a huge chunk of what you could transfer. On the other hand, when you have a $13 million exemption, it seems to me I'd rather see a client do a comprehensive financial plan, justify, determine what should be transferred, make some large gifts to SLATs, SPATs, DAPs, the appropriate trusts, and stop with the ritual of the annual gift, because do they do the crummy powers right? Do they get the checks cashed in time? It often doesn't pay for a chunk of our clients with exemptions so high to do what historically was done in terms of annual gifts. We should rethink it. For some clients, not worth the bother. Clients are funding an ILIT insurance trust with annual gifts. It may be better just to make a one-time gift, file a gift tax return, and not deal with crummy powers for years to come. So I think it's important to rethink this concept of annual gifts. For some clients, it just doesn't make sense. Clients with another situation with life insurance, since I mentioned life insurance trust, take a look at the trust and see whether there's an advantage to decanting an old style ILIT that may give everything out to the kids or the other heirs at age 30 or 35 into a more modern long-term trust. Maybe you make a late allocation of GST and you get everything done. Jonathan, I'm just going to make one quick comment on charitable gifts, and I think we can wrap up unless you have any other thoughts on year-end planning. Just keep in mind, and there's a couple of cases cited in the materials. Forgive me with the cough, I'm sorry. There have been a number of cases recently where the services come in and challenged the deductions for charitable contributions that were clearly made, and the courts have sided with the service. The issue was the clients didn't get and report on their gift tax return what they needed to demonstrate that they met the requirements to qualify for a charitable contribution.
Yeah, Marty, the substantiation, there are cases all the time. The rules under section 170 and its regulations are clear as what kind of substantiation you need for that. So please do it. You can make a great gift. It's complete, charity has it, but it isn't properly substantiated as the tax law requires. You get no deduction at all.
None.
And it's not something that, you know, well, I kind of did it. Everybody knew. They actually, charity admits it got it. That will not do. So you've got to do that. The other thing is, and this is a little bit different than the annual exclusion, you can write a check on December 31 and put it in the mail to your favorite charity, and you will get the deduction that year. But make sure you get that substantiation back from the charity by the time you file your income tax return.
And the reason I wanted to bring this up specifically in a year-end planning course program is so many programs I hear talk about year-end planning and how you make gifts and charitable contributions and doing it before year-end and donor advised funds, all good stuff. But if you don't remind the client, get the proper substantiation. You know, you can Google and get the IRS publication on irs.gov. They can read it themselves. They have to meet the requirements or they're going to lose their deduction. So you can do this wonderful year-end charitable planning, and it's a good deed, and it's great, and it's good from the tax perspective for the client. You got to meet the requirements. I would put something in writing, an email or something to the client of what they have to do, so they can't say that they weren't advised. And the couple of slides here talk about a few of the recent cases. We talked about IRAs. I think we're done, Jonathan. Do you want to make any closing remarks?
Well, make sure you do take the required minimum distributions. Again, the IRS is generally pretty forgiving, but it's the hassle of it. You're going to have to deal with your accountant. You're going to have to deal with your lawyer. You're going to have to pay money that you wouldn't have to pay if you'd done it right.
I think, you know, a take-home message, which is what we tried to convey here, don't just do things by rote. You know, there's always nuances and differences depending on what the tax environment is. And I think we tried to point out some of these differences and some of the things that we've talked about in prior years that have some interesting implications to year-end planning. And I've tried to also kind of take a step back and not just talk about the typical year-end planning stuff, because there's so many brochures and webinars on that, but rather some of the things in a broader context that we all need to think about to make sure that the year-end planning is done right or undone, like in rescission, which I don't hear talked about much. So I wish all of you happy holidays if you're celebrating any of the upcoming holidays. I wish you all an easy and pleasant year end. I know it will be much easier and more pleasant for me than 2020 and 2021, where everybody and everyone they knew was trying to get planning done by year end. And Happy New Year.
Thanks for listening. Have a wonderful 2023.
Thank you, everybody.